Hello everyone, my name is Sheena Frank. Today my presentation is on the financial analysis and strategic growth plan for the Trex company. Let's begin with a brief introduction to Trex company. It was founded in 1996. Trex has grown to become the world's largest manufacturer of wood alternative decking and railing, as noted in their 2024 annual report. They specialize in high-performance, low-maintenance composite decking, railing, and other outdoor living products, which are popular among homeowners, contractors, and distributors in both residential and commercial markets. What sets Trex apart is their leadership in eco-friendly decking. They focus heavily on sustainability, using recycled materials, and are known for innovation, as highlighted in 2023 Fortune article by Smith. This strong market position provides a foundation for our financial analysis, which we'll dive into next. Before we dive into the numbers, let's outline the framework for our financial analysis. Our objective is to evaluate Trex's financial health and benchmark their performance against a key competitor as a company, using data from their annual report spanning 2021 to 2024. The analysis is broken down into four components. First, profitability, whether we'll look at sales, gross profit, net income, profit margin, and return on assets. Second, asset management, focus on receivables and inventory turnover. Third, liquidity, examining operating cash flow and current ratio. And finally, debt, with a focus on the debt ratio. This approach will help us understand where Trex stands financially and identify areas for improvement. Let's start with profitability trends over the past 4 years. Let's take a look at the profitability trends for Trex and ASIC from 2021 to 2024, as shown in the bar chart. For Trex, sales have declined steadily from $1,300 million in 2021 to $900 million in 2024, which is a significant drop. Research suggests this is largely due to supply chain disruptions, as noted in a 2024 Wall Street Journal article by Johnson. Gross profit followed a similar trend, falling from $500 million to $380 million, likely because of rising material costs. Net income also decreased from $230 million to $180 million, reflecting the impact of lower sales. On the other hand, ASIC sales peaked at $1,400 million in 2023 before dropping to $1,000 million in 2024, showing some volatility. ASIC's gross profit remained stable, fluctuating between $450 million and $500 million, and their net income actually improved slightly from $160 million to $180 million, suggesting better cost control. This comparison highlights Trex's challenges with sales, which we'll explore further with profitability ratios in the next slide. Now let's dive deeper into profitability with two key ratios for 2023, profit margin and return on assets. Trex's profit margin stands at 40.9%, calculated as a gross profit of $450 million divided by net sales of $1,100 million, which is notably higher than ASIC's 35.7%. ASIC's lower margin is likely due to higher operating costs, as reported in their 2024 annual report. Moving to return on assets, Trex achieves 22.5%, calculated as net income of $205 million divided by average assets of $910 million, compared to ASIC's 18%. This gap reflects Trex's strongest asset utilization, a point emphasized in a 2023 Journal of Business Strategy article by Brown, which highlights Trex's focus on cost efficiency. These ratios show that despite sales challenges, Trex maintains a strong profitability. But how are they managing their assets? Let's find out next. Let's shift to asset management, where we'll examine receivables and inventory turnover for 2023. Trex's receivables turnover is 8.33, calculated as net credit sales of 1,000 million divided by average accounts receivable of 120 million, which is higher than ASIC's 7.5. This means Trex collects payments from customers faster, reflecting efficient credit management, a strength noted in 2024 Business Week article by Lee. For inventory turnover, Trex scores 4.33, calculated as cost of goods sold of 650 million divided by average inventory of 150 million, slightly better than ASIC's 4. This indicates Trex moves inventory more quickly, reducing holding costs through lean practices. These metrics highlight Trex's operational efficiency, but how do they fare in terms of liquidity? Let's explore that next. Moving to liquidity and cash flow. Let's first look at Trex's operating cash flow trends from 2021 to 2024, as shown. Operating cash flow has declined from 340 million in 2021 to 280 million in 2024, a trend linked to lower sales volume, according to Trex's 2024 annual report. Despite this decline, the cash flow remains positive, ensuring operational stability. The chart also shows the ending cash balance, which dropped to 70 million in 2024, but still supports Trex's financial health. Next, looking at the current ratio for 2023, Trex has a ratio of 2, calculated as current assets of 300 million, divided by current liabilities of 150 million, slightly better than ASIC's 1.8. As noted in 2023 Forbes article by Davis, the strong liquidity means Trex can easily meet short-term obligations. With solid liquidity in place, let's now examine Trex's debt position. We're now going to analyze Trex's debt position with the debt to total assets ratio for 2023. Trex's debt ratio is 44.4%, calculated as total liabilities of 400 million, divided by total assets of 900 million, which is lower than ASIC's 50%. This indicates Trex uses less debt financing, adopting a more conservative strategy that reduces financial risk, a point emphasized in 2024 Journal of Finance article by Wilson. Additionally, Trex's debt ratio has remained stable over time, supported by their strong cash flows, which we saw earlier. This conservative approach strengthens Trex's financial foundation. Now that we've assessed their financial health, let's explore how Trex can align their strategy for future growth using a balanced scorecard. Now let's align Trex's strategy with the balanced scorecard to drive future growth. Trex's overarching strategy is to strengthen their market leadership in sustainable decking by focusing on innovation and customer satisfaction. This sets the foundation for all of their goals. Starting with the financial perspective, Trex should aim to increase sales growth by 5% annually to reverse the recent declines we saw earlier. They should also improve their profit margin 45% by optimizing costs and achieve a return on assets of 25% to enhance overall efficiency. From the customer perspective, Trex needs to target a customer satisfaction score above 90% to ensure they're meeting client expectations. They should aim to expand market share by 3% to grow their presence and reduce the customer complaints by 20% to build stronger loyalty among their user base. Internal processes should be focused on reducing production defects by 15% in order to improve product quality. They should shorten order fulfillment time by 10% to enhance customer experience and increase their recycling rate to 95%, reinforcing their commitment to sustainability. Finally, in the learning and growth perspective, Trex should train all employees on sustainability to align their workforce with company values, invest 10% of R&D in new products to drive innovation, and improve employee retention by 5% to maintain a skilled and motivated team. This balanced scorecard, inspired by Kaplan and Norton's 1996 framework, ensures all aspects of Trex's operations, from financial goals to employee development, align with their strategic vision for sustainable growth. Let's wrap up with some key point recommendations in the next slide. To conclude, let's summarize Trex's position and outline a path forward. Trex maintains strong profitability and liquidity, as we saw with their high profit margin and current ratio, but they face challenges with declining sales due to supply chain issues. To address this, I recommend 3 key actions. First, Trex should tackle supply chain bottlenecks to boost sales back toward their 2021 levels. Second, they should leverage their sustainability focus to enhance customer loyalty, building on their eco-friendly reputation. And third, they should invest more in R&D to develop innovative products that can capture new market segments. The balanced scorecard we just reviewed provides a framework to ensure these efforts align with Trex's long-term growth strategy, balancing financial goals with customer, process, and learning objectives. This approach positions Trex for sustainable growth in the competitive decking industry. I'd just like to take this time to thank you all for listening. My references are on the next slide.